In just 29 minutes today, China's stock market plunged 7% and then was shut down altogether for the day. It's the second time in just 4 days the China markets have crashed badly, sending major ripples around the world, including on Wall Street, where the Dow dropped nearly 400 points and continued a 2-week slide. Let's look at what's behind the great fall in China with David Wessel, director of the Hutchins Center on Fiscal and Monetary Policy at the Brookings Institution. He's also a contributing correspondent to the Wall Street Journal. David, help us puzzle this out. China's economy, or at least its markets, are not that big, but the reverberations certainly were.
That's right. China's economy is pretty big. And I think one thing that's going on here is that people are saying, uh-oh, the Chinese economy might be slowing more than we thought, and the government is having a hard time stimulating again. So that's one thing. There's worries about that. But you're absolutely right. China's stock market is not very big. And yet, when the stock market has a bad day in China, it seems Europe has a bad day and then we have a bad day.
And so what is that connection between the 7% drop in China and a 400-point drop here?
I think it's hard to understand in economics. It's easier to understand in psychology. It's a kind of panic or a sense that the world economy is just not in as good shape as we thought, so everybody is chasing everybody else.
And that is something which this psychological panic is always what drives markets, not necessarily anything that makes any other kind of economic sense.
But there is the fact that people have had a lot of confidence that the Chinese leadership could fix what's wrong with their economy so it wouldn't have ripple effects around the world. I think that confidence is being shaken by how difficult it is for them to manage their stock market and their currency.
Well, let's talk about them managing the currency. That was part of the solution here, which is to let the currency fall. But that seems to be making it worse.
Right. So I think it was seen as a symptom that the Chinese leadership may be really scared about their economy. Why would they want their currency to fall? Well, the only reason you'd want your currency to fall, if you could control it, is in order to get more exports. Why would you want to depend more on exports if you're a country that has a stated policy of relying less on exports and more on consumer spending, domestic spending? They must be worried about consumer spending not being as strong as they had thought.
And then stopping trading mid-trade. I remember when that happened on Wall Street here, and it sent complete panic throughout all the investors here.
Right. I think the Chinese are really amateurs when it comes to running markets. You know, they don't really believe in markets. They like stability, they like control. So we have circuit breakers here, and if the stock market falls some, we take a pause in trading. But in the U.S., stocks have to fall 20% before we shut down trading for the day. The Chinese shut down trading after only 7%. And I think what they put in as a way to make people collect their wits, cool down a little bit, has instead accelerated panic. I wouldn't be at all surprised if they change the rules soon.
Do you expect that there will be continued volatility there as well as here?
Well, nobody really knows what the market's going to do, but it sure looks like we're going to have a lot more volatility. At some point, people may decide that the U.S. stock market has fallen enough. After all, the U.S. economy seems to be getting better. That what happens in China is not going to have that devastating effect on car sales here, or how many people buy Apple phones, or what happens at how many people shop at Walmart. So it may be that the U.S. stock market starts to rise if people think it's gone far enough.
But you have alluded to the fact that people are worried that that is not what's happening with the Chinese economy, that in fact it may not be that resilient.
Right, that's the fear. People have put a lot of faith in the government's ability to get growth going in China. People have this, what I think, illusion that there's 6 people in China who really have their hand on every button. And what we're learning is it's a very big economy and they're not that good at it. So people's confidence in their leadership has been shaken. If the government can't get the economy moving again, they have a lot of fundamental problems they may now show through.
Is there a way to draw a loop between what's happening in China's economy, what's happening here, and what's happening with the depressed price of oil around the world?
Yes, there is. I mean, I think oil prices are down for 2 reasons. One is there's a lot of supply. There's a lot of supply because the U.S. now produces a lot of oil, and there's a lot of supply because the Saudis seem to want to produce a lot of oil, maybe to punish the Iranians and the Russians. But there's also a concern that there's a lack of demand for oil. And so when commodity prices fall, it's good if you happen to be a consumer, but it's sometimes seen as a symptom of a weakening economy. So I think that exacerbates the feel that maybe China's slowing down. That means it'll be buying less from Africa and Latin America. That means Procter & Gamble and Coca-Cola will sell less in Latin America and Africa. And so it is definitely related.
Fascinating. David Wessel, thanks as usual for clearing it all up for us.
You're welcome.